Welcome to Global Risk Community Chat. Today our guest is Andreas Ita. I'm very happy to have you here today, Andreas. Welcome.
Hello, Essen. Nice to be here, and thanks you for the invitation.
Yes, so before we get into our topic, can you briefly introduce yourself to our audience?
Sure, many thanks. My name is Andreas Ita. I'm managing partner and co-founder of Orbit 36. We are a management consulting firm in Switzerland specialized on banks and other financial institutions, advising them in the field of strategic planning, treasury, risk, and capital management.
Sounds great. So today we will talk about counterparty risk and the collapse of Archegos. So why is this relevant for banks or risk managers?
When the hedge fund-like family office Archegos Capital Management collapsed in March 2021, a few Wall Street banks lost over $10 billion. Credit Suisse alone was left with losses of 5.4 billion, but also other banks like Nomura, UBS, or Morgan Stanley incurred large losses. It's notably that other banks, for instance Goldman Sachs or Deutsche Bank, lost no or only marginal amounts. This shows that good counterparty risk management is absolutely key.
Yes, indeed. So how would you define counterparty credit risk, and why is it a critical consideration in financial transactions?
Counterparty credit risk is the risk that the client or trading counterparty is unable to meet its obligations in a financial contract, for instance, in a derivatives transaction. If a counterparty defaults, the bank may incur a loss since it has to replace the trade with a new counterparty at today's prices. This is a problem if a contract has a positive value for the bank. If it's the other way around, if the contract has a negative value, that's not an issue, since then the other bank has the counterparty exposure. However, it's important that banks are aware that the design can change. For instance, if the underlying asset suddenly changes or jumps, it can happen that the value of the contract changes from negative into positive, and then suddenly a counterparty exposure is there. To mitigate the risks, banks typically ask their counterparties to provide collateral, for example, cash or liquid securities. For derivatives transactions, it's the so-called margin, which ensures that the counterparty can meet its future obligations.
Thank you so much for that definition as well. So following up from that, in what ways did Archegos capital collapse highlight the weaknesses in existing counterparty credit risk management practices?
There were weaknesses in essentially three areas. First, the margin turned out to be insufficient. The share price movements were much larger than expected by the bank's margin models, which was aggravated by Archegos' fraudulent trading strategy and the fact that several banks had the same exposures, which was, however, unknown to the banks. Second, the banks heavily underestimated the loss potential of the transactions in their risk models. In some cases, the banks were even unaware of their large exposures. Most prominent example is Credit Suisse, which had shortly before the collapse open derivative exposures of more than 20 billion. It's in the meantime known that neither the bank's executive board nor the board of directors knew about that exposure. Third, the case revealed significant gaps also in the regulatory capital framework. The risk-weighted assets for counterparty credit risk were heavily underestimated. At Orbit 36, we recalculated the CCR RWA for a hypothetical $20 billion swap exposure as arranged by Credit Suisse with Archegos. We believe that the exposure resulted in less than 1 billion of RWA, and was therefore difficult to detect.
Thank you for that as well. So based on these, what changes can financial institutions implement to better assess and manage the credit worthiness of their counterparties post-Archegos?
That's a very important question. So the credit worthiness in the sense of financial robustness or rating was not really the issue here. However, the banks need to better take into account the client's trading strategies, but also behavioral aspects. Archegos is a very good example because the client had a problematic past. Already in 2014, the owner of Archegos was accused of market manipulations so that the banks could have been warned. The banks need to improve the client onboarding processes, but it is also equally important that they understand and ongoingly monitor the client's trading strategies.
Thank you for that as well. So following up again, how should financial firms adjust their risk management frameworks to prevent future incidents similar to Archegos?
Next, to better understanding the client, it's also key that the banks are able to identify the loss potential of certain exposures. For instance, more collateral can help, but it is also important to properly define the closeout strategy and regularly test it. In the case of Archegos, some banks acted faster than others. Those who were slow were hit the hardest.
So I have one last question, and that is, what role do stress testing and real-time monitoring play when we are identifying potential counterparty credit risks, and how can these tools be improved?
Again, a very good point. Stress tests are a very powerful tool to identify Archegos type exposures. Generally, stress tests would have allowed to identify the exposures, but only if they were appropriately designed. We did an analysis at Orbit 36 and we observed material differences between the regulatory stress testing methods implemented in different jurisdictions. I can give you here some notable examples. For instance, the hypothetical 20 billion exposure that we mentioned before resulted under the ECB's stress testing methodology in a stress loss of a 9.5 billion. The exactly same hypothetical exposure would, however, only have resulted in a 3.7 billion under the US stress test CCAR. And most notable, under the UK PRA's method, which was applicable in 2021, the stress loss would even have been zero, since the PRA decided in 2021 that collateralized trades should not be stressed. After Archegos, that has then again been changed. Importantly, Archegos has also shown that the legal entity booking model used in large international banking groups can play a critical role. In the case of Archegos at Credit Suisse, it partly rendered the regulatory stress tests ineffective, and it may have slowed down the reaction time as some responsibilities were allocated to people in different time zones. So when the share prices fell in late US trading hours, some key people in London already left the office and could only react the next morning. Real-time monitoring is absolutely important in order to identify potential margin shortfalls and missed margin payments immediately, allowing for a faster reaction time.
Yes. Thank you so much. Well, that was, as I mentioned, all the questions I had. Do you have anything else you'd like to add?
No, that's all from my side. Thanks a lot for the interesting interview, Edse, and thanks again for the invitation.
Yes, likewise. Thank you so much, Andreas, for being in our discussion today.
Sure, many thanks.